Is the first episode of season 3 of Stride Live, and I am joined by the awesome Hartland Ross. Hartland, thank you for joining me here today.
Hey Casey, no problem. Looking forward to it. Excited, and thanks for asking me to join. Just kicking off 2026.
I first met Hartland this past November at IT Nation. He did a great presentation. I can't remember who else you did the presentation panel with, but we were talking about MSP M&A and non-traditional buying paths. And I really thought your insight coming from a non-traditional and M&A path within the industry was just, one, very insightful in the session, but two, I was like, I got to get this guy on a Stride Live next year. So I really do appreciate you jumping on today.
Hey, thanks very much. Well, let's see what we can talk about. Excited to see where this goes.
Awesome. So for today, we're talking MSP M&A metrics that matter. And Hartland is actually the founder of the MSP Host Broker, and I want to let him talk a little bit about that, what he's seen from his perspective of that M&A buyer's journey. Just, hey, where have you sat within the MSP M&A industry, and what's your kind of unique position within that space?
Yeah, look, I'll just clarify. We have two domains. They both go to the same place: the hostbroker and .com and the MSPbroker.com. These days, we do most of the work that we do is in the MSP space. But historically, and to answer your question, we came from the hosting and infrastructure space, where we did a ton of transactions over a long period of time, many years. And saw a lot of consolidation there, and frankly, I think that what we saw there was kind of what we're seeing and going to see continue in the MSP space. And I think that's one sort of area that's unique in that we've sort of been through this, been there, done that, but in a different industry that evolved on a different timeline. But nonetheless, just a lot of consolidation. Initially, very very fragmented, as the MSP space is now, and that ended up getting the hosting space got very consolidated, and so as a result, we're a little bit of our victim of our own success in that we did so many transactions. There were just fewer companies in the hosting space, and so we moved into an adjacent space where there was already a fair bit of overlap. We were running into MSPs that were interested in hosting. We had MSPs that did some colo or infrastructure support, and so it just sort of made sense. So we still are very active in both, but these days it's more MSPs than anything else.
Yeah, and MSP and M&A, it just seems to go hand in hand. I spoke last year about M&A really at Exchange about what I've seen in the space. We talked with so many MSPs personally. Myself, over the last couple of years, I've talked with 300 or 400 plus owners, and there's always that conversation with, hey, I'm an MSP owner and I like to sell in 3 to 5 years. We have a joke here at Stride where we say, hey, every MSP owner wants to sell in 5 years, because that's just kind of the trend of the space, as you have that first generation that anchored the MSP industry for 25, 30 years are now transitioning on. And we also do see quite a bit of young, youthful energy, both men and women in their 30s, 40s, that are looking to take that transition. But what I want to talk about today, and this is just a topic that's been so close to me, is what actually matters, because there is a lot of misconception when it comes to what metrics matter, what financial metrics matter, and what MSP owners, which they have so many priorities, what they really should be focusing on to really increase their valuation and improve their likelihood of attracting the right buyer and maximizing their seller position, because that's where we see a lot of our clients and a lot of our experiences on the seller side, and then supporting buyers that say, hey, I have this MSP I'm looking to acquire. I'd like to purchase them, but I can't make sense of the finances. So where I really want to get into today is, I've heard you talk a lot about really the EBITDA, and I know that's a common term where everybody talks about EBITDA as a whole, and that's where a lot of the focus goes in the M&A market. But you've talked about adjusted EBITDA and something that we're pretty high on here, which is really true cash flow. But I want to kind of give it for our viewers. Can you quickly just summarize what's the difference between EBITDA versus that adjusted EBITDA number, and why is it important for these MSP owners who might look to sell?
Yeah. So the first thing that I'll say is that we end up with these conversations on making these adjustments, and we go through the adjustments with a business owner, and then the light bulb goes off, if it hasn't already, to say, well, hey, wait a second, the more adjustments I make, the better my EBITDA typically is, And so I'm just going to make more and more adjustments. I'm going to crank that number up. And since valuation is a multiple of my adjusted EBITDA, hey, my valuation is going to go up. So I figured this thing out. The only problem is that buyers are kind of ahead of that. They've seen that before, and so they're going to poke holes in your arguments and your assumptions. So really what we're trying to do here in making the assumptions, or if you like to use the term normalizing, is what does the business look like from a profitability perspective, a cash flow perspective, under, let's say, normal operating conditions. So most business owners, not all, particularly those who have a partnership, tend to be more sort of diligent with respect to what expenses they're putting through their business. But if it's an owner-led, single owner-operator business, there tends to be a lot of personal expenses that are run through the business, and that those things need to be put back so that will give you that lift, right? That lift in valuation typically. Now there are some things that will pull it the other way, but we first need to add back those personal expenses, and these are things like vehicles and healthcare expenses and cell phone plans for your whole family and meals and entertainment that are tacked on to the end of that conference and so forth. But they can go the other way, and so one of the big ones is, well, the owner is underpaying themselves, right? So you as a business owner, and this is honestly the one, Casey, and you and I were chatting before the session here the other day, and this is the one that we see as one of the most controversial, particularly on smaller MSPs. And I think that it is important to understand within the context here of what size of business we're talking about, because the smaller the MSP, the more significant these add backs will be, particularly around owner salaries, right, as a percentage. And so understanding that, are you active in the business on a full-time basis, or is it something less than that? What's your contribution and what's your market rate? And I think that too many times the owner either rightly so or convinces themselves that they're not very active in the business. And so, as I say, sometimes it's fine, but in most cases, they're diminishing their contributions, and therefore the add backs as well. You know what? I only work 10 hours a week, and so I don't need to add back very much and add in as much of a salary for myself. But they're underestimating their overall contribution, and then an owner will see through that. So I think that is probably one of the biggest ones that we see is this aggressive set of add backs.
We see a lot of scrutiny from a tax perspective, with many MSPs being S corps and not completing what's called a reasonable compensation analysis. I.e., hey, I'm an MSP owner, I'm leading everything. It's, let's say, $1.5 million, $2 million. I'm paying myself $50,000, $60,000, but then I'm taking $100,000 to $150,000 in distributions. And that can also, we've seen in our perspective, that can increase your risk of exposure from a tax liability perspective. But it also, when you're looking at M&A, it's a threat, and it can be a value reducer, because it's going to open up the lens of, do we need to take a deeper due diligence into your tax history from a perspective? Are we inheriting any adjacent liabilities with this business, depending on the transaction they're looking at? But I think that's one where owner compensation, it really comes down to, do you have the right tax preparer and advisor saying, here's the entity structure you are from a tax perspective, not you're managing, I'm an LLC, but truly sole prop, partnership, S corp, C corp, and are you paying your leadership, not just ownership, but ownership and leadership adequately? Because obviously this is seen from an M&A perspective as an asset that needs to be brought into some other structure or entity. And those are things where, if you have a clear structure, the same thing on your contract side, it's going to give a lot more clarity around what is the true compensation burden for the business, and where is some of that profit and cash flow going. And to your point, I think many MSPs don't hear, in any transaction, they're not familiar with the concept of an add back, because there's so much misinformation around EBITDA and its importance, first and foremost, where we try to eliminate that by saying, hey, EBITDA is great, but make sure you're focusing on cash flow. Is this asset that you're running driving consistent positive cash on a monthly basis? Because that's going to be seen as a positive regardless of what industry field or who you're looking to sell to. It's one of those foundational steps. So
and I think that the other thing that we ended up seeing sort of related to that is someone making the argument that, well, yes, I work 30 hours a week in the business, but pay 5 hours of it's for marketing. I'm sure the buyer has a marketing person already, so they can take that part.
Yes.
And I do some the invoicing and bookkeeping and overseeing and stuff like that, so that's another 5 hours. But I'm sure they have an accounting team that can handle that. So hey, we don't really need to put that in. And that works when it's an hour or two here or there, but it doesn't work when it's significant and you're sort of parsing out your entire more or less full-time role into other people. And there's a cost at the end of the day that the buyer is going to bear for pushing these, whether someone else has to stay late, work a bit more, or push some of their responsibilities off to somebody else. So at the end of the day, it needs to be factored in.
Yeah, I think where owners spend their time too, as you're looking to sell, we're big fans of building process-oriented businesses, saying, hey, it can't be the rainmaker with that individual owner-driven business. Like we've seen many MSPs say, hey, my value's not as great because the owner's doing sales, the owner's doing accounting, the owner's in every single process, and that process is very ambiguous and it can't be replicated. It's not standardized, and that adds to a little bit of buyer wariness because they're going to say, hey, how am I supposed to bring this in without bringing you on? And I'm sure you've seen, as we have, many MSPs where the seller, the owner of the business, stays on for 6 months to a year or some sort of transition, and it's not always in the plan of, hey, they want to be in software development, or if they want to be a vCISO or some other adjacent service for the new company or entity. They're really there by necessity because they have to standardize and build processes. We've seen that reduce the value because now that's another investment that the buyer has to make sure that asset maintains at least some sort of 80 to 90% true value over that first year, where you're not losing clients, you're not losing employees, you're not losing sales. And I think that's one of those, and we'll talk about this a little bit later, but the valuation metrics that aren't financial, that are truly that process oriented. But I want to stay on the financial before I get off onto a little tangent here. So you mentioned about add backs. What are you mentioned some of the most common add backs, but what are some of the areas where you truly see outside of that salary where they might be trying to overinflate that number to justify a higher EBITDA?
Well, I mean, I'll just give you for instance, actually, that came up this morning on a transaction that is being currently negotiated, and the idea was the pushback came from marketing and or let's say organic growth, okay, and that so if you have organic growth, you are in all likelihood making efforts in some direction towards supporting that, right? You've got referral relationships, you're running ad campaigns or whatnot. And so, we've seen a tendency, for example, for an owner to cut marketing, 6 months before they want to sell, saying, well, hey, it wasn't working anyway, we didn't need that. But that is contributing to that organic growth. And so you can't have your cake and eat it too. So if you want credit for saying, hey, the buyer's looking at this going, hey, this is a good business. It's growing at 15% year over year organically, not from price increases, not because of acquisitions, but simply through organic growth. Then at the same time, as much as you're going to get the benefit for that, there needs to be the corresponding costs that are supporting that. And so if you pull those costs away and there's no marketing, well, that growth that you're wanting credit for is no longer going to be sustainable. And so if you want to get the benefit of one, you have to factor in the other. And so there was a transaction we're working on right now where the buyer pushed back, saying basically there is no marketing expense, and we're having to add that back in. So that's just one example, but there are those types of things. There are also other ones I could talk about around proprietary software on tech stack that someone wants to replace. So there's essentially very little cost of goods sold associated with something that's proprietary, although there might be some maintenance cost to sort of contribute some R&D, but there's probably a higher ROI on that, and they may not want to keep that. In other cases, in very small MSPs, their tech stack might be first of all very slim, so they're not even using, for instance, a PSA or an RMM tool. There's no ticketing software. They're just using email for support. And then other instances where they're not sort of using best in class applications, and so some of those tools are coming at a fraction of the cost that let's say a best in class tool is at, and that the buyer is already is part of their stack already, and so they will need to implement that, and there's an additional cost there. So those are some other examples.
Yeah, absolutely. We talk about that quite a bit on the PSA and the software stack. That's kind of that graduating next step of, hey, once you're on one of the big three, ConnectWise, Halo, Autotask, is making sure that PSA is set up correctly, because whether or not you want to, usually your buyer is using something and they're going to integrate you to that something. And the closer you are to an industry specified standard, some sort of consistency, the little bit easier it is. And it also, we get the question sometimes, should I pick my PSA based on who or if I sell, or if I'm looking to change from one to the other? And I usually say no, because there's a buyer across the board for everyone. And at the end of the day, if you're Halo and they want you to be ConnectWise, they can make the move. Vice versa, they have the teams and they're going to usually bring that in. But if you're ConnectWise, I can tell you, if there are a lot of ConnectWise buyers out there of MSPs where that is kind of the more trending standard, where it might help and it's going to provide more clarity if they can really drill into, if you're using the system at best practice, they can really take a deeper look into your efficiency metrics and how they can integrate. But that's a little more of a technical, where don't mind or major in the minors, as they say. Focus on the foundational areas first. Now, one thing when you talk about MSP metrics, M&A, revenue, you hear EBITDA, like, oh, I want my EBITDA, and we try to not focus on it, but then it goes to revenue. Oh, I am at $2 million, I should sell for X a dollar of that. And when you talk about that top line revenue, so many MSPs forget and often overlook the quality of revenue. Can you outline some of the specific revenue metrics that you typically focus on, that you're saying, hey, MSP owner, buyer, or seller, here's where you should focus to maximize your value as it relates to your revenue?
Yeah, I mean, look, there's a number of things here. The first one is the sort of the holy grail of any MSP buyer is going to be MRR, right? Yeah. So contractual MRR, and so there's MRR that is just month to month, but specifically contractual MRR is ideal. So when we talk about like quality of revenue, we're wanting the quality is, hey, is this predictable, right? Is this something that they can take to the bank? And in some cases that literally might be the case if they're trying to get a loan, SBA loan or whatnot. And then of course there's margin on there, so there's price points, and is there alignment with respect to your client base. Moving a $75 a month customer to a $200 a month customer is a big delta, and not likely, right? So that's important, and then you could look at other things like the tenure of those customers. So how long have they been around for, and what's the we look at like the out clauses on the contracts, if there is one. Is there an ability to cancel them, and do they are they assignable? So this is all sort of speaks to like the stickiness, right, of the customer.
Yeah, and that's one where actually this was something I attended a channel. ChannelCon a few years ago. I was listening to a presentation, and one of the big concepts was the quality of your revenue also depends on the quality of your PSA, meaning, like you mentioned, is this a contract that's sticky? Do you have clarity in a documented, not a handshake agreement of a contract from 10 years ago because you knew the buddy or the owner of it, now it's this massive engagement. Plus that level, like you mentioned, what is that growth rate? Are these contracts that are going to grow? What is the standard rate? What are your clients used to paying, and how long do those clients stay? Those are when you talk about metrics that are non-traditional. That's where I like to focus on is, hey, you can answer these questions if your PSA is set up accordingly, and that's where that client management, that CRM, really comes into a huge play for when you look at how do we evaluate the value of your revenue. Because so many MSPs will come to me and they'll say, and come to us and say, hey, I'm making X amount of revenue, but I'm not really sure how profitable it is, how scalable it is, how much we've grown. A couple years ago, we were X amount of revenue, and now we're a little bit lower, but I think it's a better quality. This is where, if you answer it not just from a financial lens of, hey, where do I get that information? It's going to come from your client service agreements, and taking that annual look to review agreements, even if it is a 3-year agreement, checking the language, checking the profile, what's changed, who's changed. And because more often than not, let's be real, you sign a new client as an MSP, they're probably not staying at that rate they're paying for those full 3 years. There's add-ons, there's projects, there's other associated revenue that goes with it. Being able to see that customer profitability is a huge driver too. I think.
Can I just jump in there and say,
Yeah.
look, I mean, this is your wheelhouse, but we love this stuff, right? And
Yeah.
if I'm honest with you, I would say that it's very rare that we see this, because they're coming to us without working with a group like you, or they just lack that operational maturity to be able to have these numbers. And so, if you're working with Stride or whoever, you can implement these things on your end to the extent that you can solve some of these challenges. But like being able to do a drill down on what is the profitability by customer, what is the profitability by service, what is how are as you said, like overall, hey, I know I'm making more money, but like I don't know where I'm making money in the business. And you might actually be losing money in some places and making money in others. You might find that you've got some customers that are exceptionally profitable and others that are not. So just trying to get more insight on that data, and certainly that's obviously stuff that Casey, you and your team work on. But if we had that, man, our job would be a very different story, right? And it just being how you're able to, as a potential seller, demonstrate the value to the buyer, because you have your numbers, because they're never the buyer. The reality is, if you haven't got it, the buyer isn't going to be able to figure this out in any kind of due diligence period. It takes too long, and the data, there's no history there. So maybe a quality of earnings could uncover it, which is time consuming and expensive.
Yeah, and that's where it's funny you mentioned, because I talked with the IT valuation folks, and I've talked with many that say, hey, if you can avoid that deep due diligence and quality of earnings, which can really drive, this isn't cheap. I'm talking 50, 60,000. Like it can really drive up because of who's doing it, as opposed to working. And it doesn't have to be a Stride. It can be your CPA. It can be a financial advisor, fractional CFO, doing some sort of financial health assessment and focusing on a metric called compound annual growth rate. If you don't have that granularity of each topic of revenue and product and customer life, you can do this in a much short abbreviated version. It's going to at least compare how much have you grown over the past 3 years relative to each period, and then it's going to lead into, hey, if I wanted to answer this level of service line profitability, for instance, my MRR versus projects, what would I need to uncover that? It's a less investment to do that, and then you can jump in and say, here's the area of emphasis I have to focus before, because we see it so frequently where it's, hey, my financial data is not usable. I was approached by some offers to sell my MSP. They said I need to get my books in order. I need to get processes, my chart of accounts. I don't have my peer reporting right. They spend that year, 2 years working to get that right and building good, solid accounting and financial processes, clean up any tax messes, and we've seen it. I've seen it firsthand. It can drive that multiplier value. So you get your initial value model, and then you have the multiplier. It can drive that multiplier up quite a bit if you take the upfront investment. But just like anything else, if you take that upfront, a little bit of preventative medicine is usually better than a cure. And I would say don't go into that until you have clarity. Now, from your perspective, you did mention, hey, it would be really nice to have these metrics, and in an episode talking about what matters. What are the metrics that you wish you had access to as a evaluator sitting in the seat you are in the M&A space? If you could say, hey, if I had these metrics, it would speed the process up, or it would provide clarity to buyers and sellers a lot quicker. What are some of those metrics, if that popped to your head?
Well, I mean, as I say, like certainly a drill down on. Let's the most basic of it, which is let's talk about a breakdown on MRR versus project work versus hardware and yeah, I mean, like those ones, if we could get that breakdown, but then more specifically on. As I said, on a per customer basis would be great. Most of the time, this information it ends up being difficult to extract after the fact because it's bundled, right? Well, we bundle all of our services together as like a managed service offering, and this is what you get, or you get a certain number of hours of support or whatnot. So I wish that we could just have more detail, more granularity. And I think just, to your point a minute ago, I think the biggest piece here is really just it instills trust, right? It instills trust in the buyer. The buyer says, these guys have got their house in order.
Yeah.
And I feel every time I ask them a question, they have a response and they have a report that they can send me that gives me that information. And so it just instills a confidence. And so it's they're not in a position where the buyer has to make assumptions, because of course, if they're going to make assumptions, they're going to go on the low side to factor in what they don't know. So I think that at the end of the day is kind of what we're trying to accomplish here is they can base it on real numbers, not assumptions which they're going to lower.
Yeah, I think that's one area where we talk about clarity. We say, hey, every MSP, every business owner has an exit strategy. There's some form of exit is going to happen eventually.
Yeah.
The more you have a clear financial foundation of legitimacy, anybody can take. It's why I studied accounting. And literally, a little true story. When I looked at it, I said, you can tell any business by their financials. You can tell what they do, how they are. You can compare to other ones in their industry. If you start there, think of it, the M&A world, they're financial guys. That's how they live, they breathe, they sleep, they eat this. And if they can see that clarity, as you mentioned, it's going to provide that extra level of trust. And then once you get in the MSP specific, because a couple of years ago, the M&A buyers for this industry, they were looking at the basics, but now we see they're looking more into, they're familiar with your PSA. They know what your gross margin should be. They know what it should be on your managed service revenue. And I think that's where now you almost have to step your game up, even though it is a buyer's or a seller's market. There, as you mentioned to me earlier this week, there are way more buyers right now of MSPs than there are sellers. But you can also do things to drive your multiplier. What would you say are some of the top metrics that MSP should focus on? Hey, I know I'm within the ballpark. My financials are okay. What can I do to increase that multiplier of my initial valuation?
Yeah, so I think some of the ones that are maybe a little less talked about or appreciated. One of them is the reliance on to the extent that this exists, and I recognize that those who are listening here and your customer base is a bit varied. So to the extent that any of you have what we would call an owner-led business, right, where you're involved in the business day to day, you're kind of key to try to extract yourself as much as possible. And this isn't a new concept, but when you have the relationships with the customers, when you're doing the QBRs, when you're doing the lunches with the customers and so forth, not to say that you can't ever interact with customers, but you want to try to have them be reliant on the team, and even then, it's not one individual ideally on the team, but it is collectively the team. So that's a big one. But another actual one is underlying organic growth, that the business is growing just with its own efforts outside of any acquisitions and outside of any price increases, that there is some underlying growth. And so if people say, well, marketing doesn't work, or we're just going to do acquisitions, that's what we want to focus on. Yeah. And I think that you're overlooking and underestimating the importance of buyers seeing that this is not they're buying a book of business, they're buying a business, and they want that business to appreciate. And of course, there are going to be customers who are going to leave. Mm-hmm. So we know that's going to happen. It might not happen in 2026, but it could happen in 2027. It may not be anything to do with your fault, but those customers need to be replaced. And so to the extent that you've got organic growth, hey, we're bringing in more than we're losing, and so it's offsetting that natural churn, right? So I think that's another big piece.
Yeah, I talk about that quite a bit. And, it's that some people mention and reference that second layer of leadership, where you take the best parts of why your MSP succeeded, which is usually the personalization, that owner effect, and you standardize it. And it's not just MSPs are great at that operational leadership. I have a COO, I have account managers, I have senior technicians and this and that. But then that internal, hey, the asset that is the business, not the client list, because anything operational is really increasing the asset value of your operations. But the business itself, if you can focus, as you mentioned earlier, the marketing engine, do you have organic growth? Do you have what's called earned growth rate, where your clients refer you new business, which is ultimate success in business is when you grow through inbound leads that your current existing clients share. That's better to me than, a customer satisfaction rate. That's better than any of the customer scorecard metrics or any of their earned growth rate is one metric that I think is a little hard to track, but if you build the systems on the sales side, bringing in a good business developer who can understand the combination of marketing, sales, and partnerships, and building that process, say, hey, we brought on this client, or we have all these clients that Hartland Ross, you brought in some great clients, 20 years in business. Now we're going to build a process to get referrals and see why did we win those? Why do we maintain those? How do we continue to grow those relationships and have them introduce us to their other circles? That can be a massive driver when you talk about that, because if you find the right buyer who wants to keep that brand identity, they're going to have that as an asset, and you can't put a value on truly an inbound sales engine where you drive leads inbound more than you are cold calling or outbounds or shaking hands, and you're generating those positive referrals too from your existing clients. I think that's one where I've seen be a huge multiplier for many MSPs, because then they can prove that, say, hey, yes, you have good clients, they stay here for a while, your operations are good, but you can also do so well that you can focus the business on attracting new ones to feed that ecosystem and pipeline.
Yeah, I mean, and the piece that I'll add is of course that the referrals, those leads will close at a much higher rate than any of the other ones, and so it's just a lot easier, right? The problem with it is that they're generally limited, and so relying on referrals or that strategy alone is usually not sufficient to kind of drive growth at the rate that it needs to be.
Absolutely.
But if you have that box checked and you're maximizing it, then that's great. And if you aren't, then certainly I think you're leaving some money on the table, so to speak.
Absolutely. And one of the things we've talked about too is on the how do you build marketing and sales assets, and sometimes that's around differentiation, SEO. I mean, you can talk to this on the eBridge marketing side, the search engine, ask engine optimization. Where is your presence? What are the digital and physical assets that you have? What is the identity and value of your brand? Those are other areas where once you get the operations done, hey, clients are happy. Employees generally happy. Our clients stay. We continue to add and upsell and grow our clients by adding more solutions and not just selling. Now focusing on that marketing, it's always, hey, who do you serve, MSP? I work for in the Cleveland area and I do this really well. Okay, so there's a bunch of other MSPs. They keep you up 24/7. My friend Robert Gillette talks about this all the time. But what makes you different? And the more you can identify a niche, I've seen that become a value driver where you're saying, hey, here's our finances, but here's a segment we're really high on. We've been dominating in the legal offices in our area or dental offices or whatever the niche is. I've seen a $20 million MSP that just focused on car dealerships. And those type of things can also support your valuation, because if you can say, hey, we know a market so well that we target it, we grow it, and we have a business unit that's X percentage of it, that's going to also be, I've seen, very attractive for a buyer, especially if it's regional-based differentiation, industry-based differentiation, vertical of service differentiation, CMMC, vCISO, etc. I think those are areas where you don't necessarily think, hey, is this a valuation metric, when it really is, because it talks about the operational maturity of your business and really is another marker of trust. Hey, if you're able to focus on a whole vertical of one business to grow and serve in and invest those dollars, I have confidence your business is run pretty well.
Yeah, I mean, you're preaching to the choir, right? Because we specialize in IT service firms. That's all we do, and we have right from the beginning. So, and it, as you said, I didn't mention it earlier, but we started actually as a marketing firm for IT companies, and evolved into M&A simply because a lot of clients were wanting an alternative for growth outside of organic options, and so we have both at this point. But so I can certainly speak to both, and if I was just focused on M&A, I might say, hey, don't worry about that marketing stuff. It's a waste of time. But I do think but because we see it as a driver of value on the M&A side, then I can speak to it. But I can also speak to it from being in this marketing space for as long as we have. There's another point I was going to make here. Maybe it'll come to me, Casey. Sorry.
That's all right. We're getting closer to time here, and usually what I like to do is the old too long, didn't listen, 30-second to 60-second. If MSP owners could take one takeaway on an MSP M&A metric that matters from your perspective, what's that 30 to 60 second soundbite that's, hey, if you don't take anything else, this is what I want you to focus on or take away from today?
Oh, geez. So the value of an MSP, if that's, I think it depends on where stage you're at, right? Like if you're looking to sell versus if you're wanting to kind of hold and grow and sell and as you said in the beginning, in 5 years. But I think if your time horizon gives you the time to improve these processes, then I highly suggest that you work on cleaning your house up and being able to have access to the data and frankly, improving your overall profitability and what will be the EBITDA number. If your time horizon is less, and you that's a lot of work, and I don't have the energy, the passion, the interest, or whatnot, then I think you need to sort of focus more on some of the short-term things and cleaning up your operations with respect to extracting yourself from day to day. Try to close as many deals as you can to get the revenue up, and look for operational efficiencies where you can justify removing some of those expenses to get the EBITDA up. Having a conversation with someone like myself and Casey to look at your specific situation and say kind of where am I going to move the needle most easily, then we can pinpoint that. Ultimately, revenue is a big driver, right? Like it's not a linear relationship. So growing your business is going to be the single biggest driver. So I would say overall, like push that up. But you do need to recognize that there are other factors. Like it's not just a matter of selling more hardware, for example. We talked about the quality of revenue earlier.
Gotcha. Yeah, I actually have one question too came in regards to the industry of M&A and MSPs in 2026. What trends are you seeing that sellers should prioritize?
Well, I think that there's two things that I would answer on that. If you asked us why we have conversations with prospective sellers, and you asked me that question even 2 years ago, I would say that the predominant answer, and predominant didn't mean that it was like even 50%, just that it was the most answered or given response, is that they lost passion, lost interest. They were tired. They were worn out. Their lead tech just quit. They lost their biggest customer. They had a bad day. That happened on Friday, so we get a phone call on Monday saying, "I want to sell. I'm done." And we had a lot of those. Now it's retirement. Groups have moved into that stage, and so I was just actually at an economic discussion yesterday around the number of businesses that are going into retirement and business owners, and that number is going to peak here in the next number of years. 5 years is the figure that I'd heard, and so you are now, as a seller, going to be competing with other groups that want to also sell their business. Mm-hmm. And frankly, part of the reason that we have got a challenge here with high valuations and more buyers than sellers is because it's a supply and demand imbalance. But as more groups want to sell their business, it's going to tip the scales a bit, which means that buyers are going to be able to be more picky about what they are looking for, and ultimately fewer offers on every individual deal, which will drive valuations, I think, at some point, if not down, it'll at least stabilize those and put a little bit of downward pressure. And then the other sort of part B of this, which is unrelated but important, is the advent of AI and implementation. And so to the extent that you can make your business more profitable by operationalizing and streamlining the process with AI, reducing labor or other expenses, and so you have a more profitable business. So I think that if you recognize, and so there's going to be this these kind of legacy MSP businesses, much the way it was before the MSP business. It was the break fix business, right?
Yeah.
So you have these kind of legacy IT consulting businesses billed by the hour. Then hey, they still have value, but everybody who buys them now wants to convert them into a recurring revenue model business. So we have that, but then so then we have another layer on this, which is, hey, to what degree are you implementing AI? And there's going to be this kind of legacy groups that haven't really adopted AI in any meaningful way. And again, there'd be downward pressure on the values of those. So I think that those are two things to consider if you are looking to sell, is like, what's my business going to be worth in 3 or 4 or 5 years if I don't implement AI? And I'm also now in a position where I'm competing with a number of other businesses because of more of a glut, let's say, of businesses on the market.
Absolutely. And I think the AI, there's a lot of fear around that, but it's not always, hey, let me just find a new software, new tool. It's where can I make automations? Where can I use AI to automate processes in the business that are manual? And I've seen MSPs that are now using AI as a service line where they're selling sales and marketing automation and artificial intelligence implementations and services like that, and getting MRR by managing and hosting AI-based automation tools, which is pretty awesome. I attended something at 𝐏𝐿Con this past year in New Orleans in September. That was it was all about how MSPs can build a service line through AI tools using AI. So you can help your clients implement this tool in their sales and marketing systems by being the tech guy, because that's really what it's turning. MSPs, it's not break fix, and it's not just managing devices anymore. It's kind of going where I started my career in the MSP industry, the VAR, software implementation, consulting, application awareness, and technical expertise route, to say, hey, there's more tools than ever that these businesses are looking to use. If these really smart, sharp MSP fellas could figure that out and implement service lines, there's a lot of money on the table. And it's not just project based. A lot of it can be MRR too, as you manage these systems for them. So we use it at Stride. We use automation and AI in a lot of our processes, and it's made me more effective. And it's not like it's replaced anything that I've really been upset to replace, especially from a manual work perspective. So.
Well, and I think just really at the end of the day, it's, as an MSP owner, you are trying to, or an MSP trying to help customers embrace technology to solve a business problem, right? Yeah. And so it doesn't matter whether the problem is related to, a network or a security, backup, disaster recovery, like, hey, we need to, or compliance reasons, but at the same time, these are the efficiencies that can be gained from AI. And so, like, I think it's just the evolution of the same story, which is getting customers to use technology.
Absolutely. Well, Hartland, we're a little past time. Thank you for taking. I appreciate it. We had quite a few viewers turning in, and I did get most of the questions in. So thank you again. If you guys want to reach out, we'll have this on Stride Live. We'll have it on LinkedIn, YouTube. We'll send an email out. If you want to connect directly with Hartland, you can. His email will be in the show description, but you can also connect with him on LinkedIn. Hartland, once again, thank you for taking the time today. I really appreciate you kicking off season 3 of Stride Live.
Thank you so much. It's been a pleasure and honor. Thanks, Casey.
Of course. Thank you.